Daniel Creech, thanks so much for coming back on Wall Street Unplugged.
Hey, Frank, great to be back.
So a lot has changed, right? I mean, you've been working here, I'd say close to 3 years now, and you were here for 2 years, you moved back to Arizona, and now you're back. I don't know if that's a good thing or a bad thing that you're working in the office with me again. I'm not too sure, but it's really glad to have you back, bud.
Yeah, time will tell. But no, it's good to be back. It's good to be back in the office and back on the podcast. Yeah, I was here for almost 2 years, did a big loop around the country, and now I'm back to Florida. So life is good, man.
Nah, that's cool. That's cool. So we're gonna get to the reason why you're back in a minute, but first I want to go because we discuss the markets a lot. You follow all the stocks in my portfolio, help write the alerts for me. For anyone who's subscribed, Daniel's is a guy behind the scenes that does a ton of work. Listen to all the conference calls, like just send me bullets on everything. Really keep me up to date with everything that's going on with the portfolios. I want to get your opinion on the markets as someone now that I don't know if that's a good thing or a bad thing that I turned you into a stock and market junkie, but I want to get your thoughts on the markets as someone that reads and listens to a lot of these conference calls, covers them during earnings season, what's going on in the market, understands the Fed. I want to get your opinions on the market. Where do you think we're headed after this huge rally coming off, that big crash? But I want to see what your thoughts are on what's the next step, right? That's what everyone wants to know. What's going to happen next? And there's a lot of opinions out there where we're hearing everything from we're going to see another crash to we're going to see stocks soar from here. So let's get the Daniel Creech opinion. What do you think?
Yeah, what a time to be alive and an analyst and a stock market junkie, like you said, because you can't talk about the markets, in my opinion, without talking about the goofy reality that we're in. And what I mean by that is financially, we are somewhere between a Willy Wonka movie and the Wizard of Oz. And the gentleman that is having, I would argue, probably the time of his life in a goofy sense, that is pulling all these financial levers and basically has a giant soundboard of all kinds of craziness, is Jerome Powell, the Federal Chair. And so if you think about where we're at in the markets, and then you think about, hey, the markets are always forward looking. Public companies trade at a premium. You have a lot of money sloshing around. That's all great. And a lot of people already know that. But when you look at the discrepancy or the difference between the stock market being basically back to near all-time highs and Main Street and the economy still slowly reopening because of the coronavirus, the only reason you can connect where we're at in reality in the stock market is because of the role the Federal Reserve is playing. And that role is simply that they are making the reaction to the 2008-2009 crisis look like nothing. They are basically backstopping, they're printing, they are putting money directly into people's pockets. And, in the short term, you can push water uphill a long way. So often in life, my family has told me, they've taught me a lot of great lessons. And the thing that keeps coming back to me is often the hard or difficult thing to do is the right thing. So if you apply that to the financial markets, with everything else going on, we'll get into the election coming up in a minute, but it's hard for me not to be optimistic and bullish, as goofy as that sounds, because they're going to continue to push tailwinds to try to get asset prices higher. I do expect a lot of volatility going forward, but ultimately, I think the path of least resistance is higher.
So there's it's great. This is a great segue because you're talking about the Fed here. You talk about Powell, where June 10th, he had the Federal Market Committee. That was the meeting that they had. Everyone was paying attention. And Powell said, listen, what I took from it was, the Fed's not worried all about the balance sheet, which I thought was amazing since it's over $7 trillion now. More QEs likely on the way. We'll continue to purchase assets in terms of like ETFs and things like that. In the credit markets, that made big headlines. But there's something that you're covering that you talked to me about, we talked about, and it went under the radar. And he said something significant. He said the Fed was considering yield curve control. And it went under the radar because I bet most people are not familiar with what that means. So, that was in addition to his asset purchases or whatever, but it basically pins the short end of the curve just above zero. So it avoids a spike in yields, which we can't have with how much debt we have, right? Especially on a Fed's balance sheet. The last time this was implemented, 1942, which allowed the U.S. to keep rates low, which was 2.5% back then. It basically allowed the Treasury to fund cheap debt during World War II. It lasted 9 years until 1951. Talk about that, because and Powell said we're considering yield curve controls. I know you've done research on this. What could that mean for the stock market?
Well, in short, you could see a massive bubble and a huge skyrocketing stock market. Now, The old saying is history often, repeats itself. It doesn't, it rhymes, but it may not necessarily happen exactly the way it did in the past. You gotta keep coming back to reality. So it is scary that they're talking about this, even discussing it. But in reality, more than likely, they're probably going to do something like this. Even if they don't do quote unquote yield curve control, they're going to keep pulling levers and keep interest rates low. But back to your point, the interesting thing was when this happened in the 40s, and that was because they wanted to keep costs low to borrow for World War II. From 1940 to 1951, the stock market had a massive run higher. It went up over 80%. Now, that's after starting the early 40s with negative years. So the PE, the other interesting thing is the PE went from 7.7 times to 21.9 times price to earnings, okay? So that was from 1942 to 1946. That is a massive, massive increase. And when you compare that to today and say, okay, well, what if we keep expanding things? Not to mention, yields, the 10-year treasury was over 2% back then. Now they capped it, I believe they capped one of them at 2.5 and all that. But again, it doesn't matter exactly the levers they're pulling. They're going to keep interest rates lower for longer. As you said, it's ridiculous that he's so blatant about it, but I guess you got to give him credit for being honest to an extent, honest in quotations. They don't care about the balance sheet. They also don't care about how 0% interest rates hurts your mainstream people. Because if you've been, I would say, a common sense person and putting a little bit of money away, you're not earning anything on that savings. So that forces you to put that into riskier assets because you have to keep up with the cost of living. So going back into the 40s, I'm not saying we're going to have that type of expansion now. And if you look at, I know we're always trying to give free sites and information to listeners. And I know you've talked about FactSet a lot in the past, but they just had a great report, I believe last Friday on an earnings insight. And they showed that right now, for the past 20 years, our PE ratio has been around 15 times. Well, 20 years is quite a bit. So let's look a little closer. For the last 5 years, it's averaged about 16.9 times. Well, we're at 21.9 right now, which is kind of funny because that's where we were back when in 46. So we're at 21.9 forward earnings right now. I'm not saying we're going to 60 and have a huge jump like we did in the past, but because, like I said, the path of least resistance is continuing to be higher because of the financial levers they're pulling, just like they did back in the 40s.
Yeah, and guys, remember, those rates are 2.5%. They're zero now, and I mean, even if we look at the average PE, I think for the last 10 years, I think you mentioned 20s and 5 years, around 15, and that PE exploded, over 150% higher. Not that it's going to be 35, 40, but it could, like the new PE, that new norm, if they do this, which they're kind of implementing already, right? I mean, they want to put the yield curve control in, but it's kind of, they have it anyway, making sure rates are as low as possible. Just look at mortgage rates, look at rates around the board, across the board. So it's something that people aren't talking about, where we always look traditionally at a PE ratio and look at a 5-year, 10-year average and say, wow, this is so expensive. But if earnings do bounce back to the levels that everyone is expecting, right? Wall Street is expecting. This is why the market's going higher. If it does, we could see this market continue to move higher because, again, with super low interest rates, no place to put your money. And look at the rest of the world globally, right, Daniel? I mean, where are they going to put their money? There's a ton of money on the sidelines right now. So when we look at everything together, it is a scary market. We're doing this on Wednesday, watching the market come down 650 points. By the time people listen to this, it could be up 650 points. We don't know, right?
Exactly.
But, looking at, this is a very, very big story that I feel like it was thrown under the radar. And again, thank Dave for bringing it to my attention. But when you just compare it to the last time they did this and how stocks exploded, and we're seeing them go higher now, there could be a lot more room to run, but it makes it a very dangerous market, especially if COVID's in there and China relations and stuff like that, which is pretty crazy. Which then let's go into the next segment, which is, how do we play this? If you think stocks are going hard, you're looking at sectors, you're looking at stocks. Again, you're doing it all day just like me. I know you love it, and we discuss the markets all the time now, especially we're in the office together. What's some of the plays on this, or maybe some of the sectors that you like?
So I'll give you a kind of a longer-term idea that I'm still digging into, and then a shorter-term play, but I'll start with the long. So comparing back to the 40s, during that time when the stock market performed well and they were doing that yield curve control, it shouldn't shock anybody that housing prices did very well. So you want to look at housing and housing related stocks. So you can start digging into home builders. CRA members may be seeing something like that soon. But you got to look at home builders and anything that'll benefit off of low interest rates. So your huge companies that can borrow money easily. So your FANG stocks, your stay-at-home plays, the well-capitalized stocks are going to continue to do well in a 0% environment. And if you have a little risk and appetite and you want to kind of mix Vegas in with the stock market, 0% interest rates, access to capital markets, your zombie companies and your high bets are have a potential to go continue higher, although with a lot of volatility. I would look at home builders, and I would also look to hedge that because I do think you should be long because of the tailwinds we have. But if you're long, I think you have to be hedged. And I don't mean hedged with just cash. I mean hedged with gold exposure or silver exposure. We can get into that if you want to in a minute. Switching to short term, because of all the fear and uncertainty surrounded by the coronavirus right now and the shutdown, we've had an excellent recovery in a lot of different stocks and sectors. But what's really got my attention right now, and full disclosure here, I'm biased towards this sector anyway, is the insurance sector. And I'm looking at both property and casualty companies and life insurance companies. Obviously, the big difference there is everybody dies on the life insurance side. So you have to run your business to a certain extent to keep those reserves and protect them because you're always going to have to plan on payouts. On the property and casualty side, you have to pay for things like, renter's insurance and auto insurance and different things like that, but you always don't have a claim. So you can take in a lot of capital, invest that, and not pay a lot of claims out. So the business model on the property and casualty side is tremendous just as is. Now, a lot of those stocks, and I'm talking about W.R. Berkley and Travelers, Chubb, branching over to life insurance side, Bright House Financial, a lot of these stocks have not come back to where they were trading before the coronavirus hit. And several of them are between 30 and 50% still off their previous highs. When I was digging through the conference call transcripts, the interesting thing to me is that the market is pricing in the insurance companies are going to be on the hook for business interruption. So what did we have? We had the coronavirus outbreak. We had a lockdown, which go off on a little rabbit trail here. I still can't believe, and I know it's easy to play Monday morning quarterback, but I cannot believe, I remember talking to you several times. We literally tried to stop the world from spinning. And I know it's a pandemic and people are dying, and I don't want to make light of that, but trying to pause the economy, I think everybody has come to the conclusion that that was a mistake. And you've seen even people down here in Florida and Texas. Hey, I know cases are spiking for coronavirus. Hospitalizations are going higher. That's one of the reasons for the market sell-off today. But I really don't think that we're getting to the point to totally shut down the economy. And I think the market is going to price that in. Getting back to the insurance side, sorry about the rabbit trail there. Getting back to the insurance side, a lot of people are fearing that insurance companies are going to be on the hook because when companies have business interruption, a policy, they have to have physical damage. So the government telling you in this office building, hey, you got to shut down, can't go to work. If you think you can go to your Travelers or whoever insurance company without proof of physical damage that you shut down, they're not on the hook for that. And I don't want to sound rash because I know insurance companies, aren't the greatest businesses at, everybody has something bad to say about insurance companies like everybody else, but you cannot just you can't sign a contract with somebody and then have them go back and say, oh, well, even though this isn't covered, you owe us all these billion. And I think that risk is being priced into a lot of these stocks. And the easy way to get out of that, just because of the world we live in, is let's say Trump or whoever in Congress comes out and says, yeah, the terrible insurance companies are just like big oil, big banks, et cetera, et cetera. So they are going to be on the hook. Well, I don't think it would be a week later that you'd have Jerome Powell come out and say that he would backstop insurances just like he backstops everybody else. Insurance is a lifeblood of financial plumbing in the economy, and it's going to be around for a long time. And I think you ought to look at the property and casualty very, very hard right now.
Now, what are some of the names you like? You mentioned a few, but what maybe one, two? What are some of the ones that you like there? Because there's one or two I think that are doing okay, but a lot of this industry has sold off, and it hasn't even come close to coming back yet.
Right. Yeah. Like the Progressive Group is doing well as far as the stock price and rebounding. I don't have them in front of me, and again, they might be way down today, but it's very good back to its 52-week highs. A couple really well-run companies are W.R. Berkley. The ticker there is WRB. Chubb Insurance, CB, are big well-capitalized, strong balance sheet, property and casualty. And then, like I said, life insurance, Bright House Financial's got my interest, but that's more of a life insurance play in that side of things. So.
Well, I'm going to give people a little insight to Daniel personally here, because Daniel's a person that's always worried that someone's listening when it comes to Alexa, because I have an Alexa in the office and he's always like, I hate that thing. And I'm going to say something because you're right. Because before we went on, you're in the office and you stepped away this way, you can take the call. This way we're not right next to each other doing this interview. But, and I said, okay, we're going to talk about this, just bullets, right? We don't, and even with all my guests, I never give them everything we're going to talk about because they seem to answer everything right up front. I like to just, what are topics you want to talk about? And I just said, insurance, what do you like? And you said Bright House Financial. Right before I pull this up, right before we actually went on air, I just checked my email really quick and I looked at their website. I think it came up to CNN or whatever because it was an article, a post, and the ad on there was Bright House Financial, and it was right after you mentioned it. I never mentioned it ever, and literally that ad for Bright House Financial came on. I don't know. You mentioned in my office. I do have Alexa in here. I just thought that was funny. I'm like, wait a minute. I never heard this. This is the first time you mentioned. I mean, I heard of the company before, but it's the first time we talked about it. And you said, yeah, I kind of like this company. Anyway. I know how you feel about that.
Yeah, it's terrible. I think our next product ought to be tinfoil hats with a Curzio Research logo. That's our next product.
I know, right? I know. So let's get into another topic here, which you're very passionate about, which is politics. We have an election coming up. We're seeing a lot of crazy stuff out there. We're seeing politicians on both sides kind of say, kind of watch what's happening, right? I mean, just there are peaceful protests out there. We all see it, and I just had a nice rant on it. But this election is going to have serious implications for investors. I mean, serious implications for investors. So, how do you play this, and what are your thoughts on it from someone? I know that you're really passionate about this. So, the stage is all yours, bud.
Yeah. So we'll talk a lot more politics in the future, and I want to warn everybody. It's not that I follow politics because I enjoy it and I think highly of them. I absolutely don't. I follow them because, in my opinion, you have to. Because what they do and what they affects you directly, and it's affecting your money. So if you put your head in the sand and ignore politics or kind of take them for at their word instead of really what they do, I think it's a big mistake. So what do I mean by that? Going into what they say and what they do. When the first CARES Act passed and the relief fund of $2 to $3 trillion was passed, they have these bonuses in place. So you have a situation where a lot of people are getting more money not to go to work right now. I know everybody's scared and there's a lot of uncertainty around the coronavirus going. Well, that supposedly runs out at the end of July. And anybody that doesn't think going into election year, there's going to be more stimulus, more money printing, and more injection of that money directly into consumers' pockets for votes, in my opinion, is just not paying attention. And I don't care if you're right or left, it doesn't matter. So whatever stimulus that is coming out in rumors, there will be another stimulus package, in my opinion, very soon before the end of July. Because if you're Donald Trump, you can't afford to tell people, hey, even if you're not back at work, your unemployment bonuses and your money's going out, there's no way they would ever vote for you. And right, wrong, or indifferent, that's the way that game is played, in my opinion. So we have a lot of tailwinds going. The other thing that's going to be, so you got a lot of people, you have people with money in their pocket, even if they have to stay home or if people get nervous because of the recent spikes in cases, and we have to continue to watch the deaths too as well and see if that spikes. But even if people calm down and say, all right, you know what, I'm going to back off and nothing's shut down, but I'm just going to stay home for a week, or I'm going to back off some things because I'm nervous. Well, human nature, you're not going to stay home for the rest of your life. You're going to get pented up and you're going to say, all right, well, screw it. I'm going to go out now and spend money and do this or that. So you have this kind of self-assurance. Hey, you got money coming in, even if you don't have a job in the short term, and the economy is going to survive regardless. But you have a lot of money in the short term going into it. And then you're also going to have another stimulus in the form of some type of infrastructure bill. So how do you make money off all this? Well, you want to put your money into some infrastructure plays or other related elections. And we could joke around about this, but what do you always joke about that you should buy coming on into an election year? You want to buy marijuana stocks. So I would start digging into those because every state is basically as broke gets, and they need revenue. So over the next 2 to 3 years, the things that are going to be legal for state revenue, I think, are going to expand dramatically. Everybody's going to be Vegas soon, Frank. And in some ways, that'll be all right.
Yeah, it is pretty crazy times and what's going on. Again, I just had a long rant about it. But and the reason why I wanted to bring up the political front is the real reason you have come back is you're going to be part of this podcast now, where we're going video. We're going to be segmenting, have segments where it's, maybe the rant at the beginning, and then, segmented into 3 different podcasts. You can listen to the whole thing at once, but we're going to be doing videos of this, setting up a studio. I have a studio up here. We're going to be setting it up to where you can watch us do the podcast, do the interviews as well, where, we have the technology, great technology, quality that's better than the CNBC and the videos that you're seeing now. Through a technology that we're using. Thanks for the person who's taping this right now to help me with all that. But really exciting stuff coming up, and I really appreciate you making the move, because it was a conversation we had, and I said, hey, you know what? Why don't you become part of this podcast? We'll be able to talk more about news back and forth, bring on different guests, just for even politics, everything that's going to relate to your money still. But we're used to having analysts on here and stock picks, and we're going to continue that, especially putting those things in our paid product dollar stock club and things like that. But I'm really excited about it, Daniel. So I want to get your thoughts, because I know you came back. We are going to be talking about a lot of cool stuff. It's going to be edgy, and the video component, I think, is really going to be cool and draw a much bigger audience. But I really hope that you're excited about that, bud.
Yeah, I couldn't be more excited, to tell you the truth. When you mentioned that a couple of months ago, I thought, yeah, that'd be really exciting. I've personally, I've always been a huge fan of radio and broadcasting. I'm a huge fan of Rush Limbaugh. I'm a huge fan of Howard Stern, just the way they deliver. I love paying attention to stand-up comedians and the audio version. So, yeah, I couldn't be more excited about getting to share thoughts and ideas and interview different people and play a bigger part. So, it was no big deal. It was just 30 hours on Interstate 10, and here I am.
I can't even make that drive, man. I don't know. I would have had someone else drive the car and maybe it's definitely safer. Maybe that's why cars are flying off the lots right now, right? Because nobody's going to take public transit. That's one thing, right? We talk about the coronavirus. I'm not, for me, if I get it, I'm not as worried. And if you're older, you should be wearing masks. And I get that point, practice social distancing. But I could tell you, as someone who's kind of like, hey, if I get it, I'll be okay. It doesn't mean I'm going to be irresponsible. There's no way I'm taking public transportation. If you take a plane, at least they wipe down the plane afterwards. But people constantly getting off buses and trains, you don't know where they've been. And I don't think they're taking a temperature before and after like they. I don't know. That's pretty crazy. So it's probably safer that you did drive the car here.
Yeah, absolutely. Yeah, not a big deal.
All right, Daniel. So great stuff. Talked about a lot. Even sharing ideas. And I know that people listen to this are going to see how far you've come, because I had you on the podcast numerous times since you've been working for us for 3 years, and just to see how far you come and what we're talking about in Fed and policy and everything. It's really cool. It's really, really cool. And I think everyone's going to be really happy that they're going to hear more from you, especially on Wall Street Unplugged. So thanks for coming on, bud. I appreciate it.
Absolutely, man. Thanks. And looking forward to more. Take care.